सच सामने के पन्ने पर नहीं होता. The truth isn't on the front page. A glossy corporate annual report is a curated narrative designed to show you growth while the actual data remains shredded and scattered beneath the surface. Economist George Akerlof identified this as information asymmetry. It is the structural advantage where company insiders possess the full data set, while external investors are left to make decisions based on filtered, incomplete information. Bridging this gap requires moving beyond the marketing and examining the three primary pillars of accounting: the balance sheet, the income statement, and the statement of cash flows. We're going to use these tools to expose the reality of value at three different levels. We'll audit a single manufacturing firm, compare the banking sectors of two rival nations, and finally audit the performance of the fund managers who trade your money.
Financial literacy provides the mathematical framework to convert these private insider advantages into public knowledge. Consider a mid-sized chemical manufacturer, like Ducol Organic and Colors, operating out of Panvel, India. Most people start and end with their sales growth, but raw sales are a poor indicator of performance if we don't know the cost of generating that revenue. Ratio analysis solves this. By dividing after-tax net income by total sales, we find the net profit margin. This shows exactly how many cents of every dollar remain after the company pays for its materials, its labor, and its taxes. We then look at the operating expense ratio. This differentiates between wasteful spending and vital long-term investments, like research and development or community healthcare programs, ensuring that current costs are actually building future equity. These ratios provide an objective map of a company's internal mechanics, allowing an investor to ignore the pitch and evaluate the actual operational health. Now, let's apply these same principles to entire national economies, comparing the top 5 banks in Indonesia to the top 5 megabanks in South Korea. Iska karan kya hai? Why is the price-to-earnings ratio of Indonesian banks consistently 3.5 times higher than their Korean counterparts? On paper, Korea's massive banking sector looks like it should command a higher premium. The answer lies in the return on equity, or ROE, and the net interest margin. These metrics represent how much profit a bank generates with its shareholders' money, and both have seen a steady decline across both nations. However, Korea's ROE plummeted far more drastically. Their government forced a mega bank structure that prioritized market share over operational efficiency. This consolidation created a massive, slow-moving industry that investors now value at a lower multiple compared to the more agile Indonesian sector. Surface-level multiples, like the price-to-earnings ratio, are often mathematical decoys. Macro metrics show that two identical industries can operate under completely different financial laws. For our final scale, we look at the ultimate insiders, mutual fund managers. These professionals charge you significant fees for the promise of active stock picking, yet many of them engage in closet indexing. They quietly replicate the S&P 500 to avoid underperforming the market, while still charging you premium fees for what is essentially an automated strategy. To identify them, we use a specific metric called active share. It calculates the exact percentage of a fund's portfolio that is truly different from its benchmark index. This formula provides an objective mathematical audit of effort. By comparing every individual asset weight in the fund against the index, we can see exactly how much of your money is being actively managed and how much is just being parked. Active share ensures that when you pay for professional expertise, you are receiving a specific, differentiated strategy rather than a hidden index fund. We have traced the path from local profit margins to national valuation gaps to the hidden mechanics of Wall Street portfolios. The goal of this analysis is the removal of blind trust. We no longer need to rely on the stories companies tell about themselves. In an environment defined by information asymmetry, the only verifiable defense is the use of hard data and historical benchmarks. To sirf upar ki news mat dekho. Demand the data, check the active share, and place your capital where the math proves there is value. The information is available. You simply have to be the one to solve the equation.